No one really likes when someone says, I told you so. So I guess I'll just say, I warned you. On August 20th, in my video, 5 Reasons Why Gold Prices Will Fall, I gave you my rationale why I believe gold would touch 1850 and silver would go under $22. While I try not to make predictions on this channel, I do try to tell you what I think I'm seeing and what I believe is most likely to happen based on the market conditions. I try to avoid these types of predictions because undoubtedly I get several comments telling me how wrong I am, or people razzing me saying that I should sell my metal since I'm so bearish. As I said in that video, I'm short-term bearish and long-term bullish. That didn't matter as the comments came rushing in, especially when gold popped back up to 1950 shortly after that video. Before we go any further, before my message gets misinterpreted, the purpose of this video is not to take a victory lap about being quote-unquote right. Let me share the words of Ezra Taft Benson. Pride is concerned with who is right. Humility is concerned with what is right. If you ask me, which you didn't, this is the biggest problem I have with most creators on YouTube. Most are concerned with being right as opposed to getting it right. This is why they continue with the same narrative, such as silver being so undervalued, you need to get it now, buy while you can, we're running out of silver, market manipulation is why prices haven't gone any higher, or that you need to get to silver or die. Or die? That feels a little overly dramatic to me. That aside, as a general disclaimer, I'm not here to call out names or take shots at any creator in particular, but I do need to speak on the behaviors that I believe are or will do harm to you as an investor or your investments. Regardless of the thumbnail or title of this video, I'm not interested in doing a victory lap. My goal is to help you develop the skills needed to ask the right questions, interpret the data, and make your own assessment of what you expect to happen. Over the years, I've shared a number of concepts I believe are critical to being a successful stacker and, more importantly, an investor in general. We all know that success can be a very poor teacher, as it's incredibly easy to confuse good fortune with good strategy. Let me say that again in a slightly different way. Do not confuse good fortune with good strategy. This is a very challenging concept because most of the time we measure our success in terms of our fortune, meaning whether or not we made money. The sad reality is that it is very easy to have an excellent investment thesis and strategy and still have your investment go terribly wrong. These investments aren't guarantees. All we can really do is put ourselves in higher probability scenarios. As an investor, the tendency is to want to be the knower of all things, the person that has all the right answers and knows the right decision to make at any given time. And that's natural because we have to own our own results. Again, the goal is to get it right and not focus on being right. When you focus on getting it right, you focus on the outcome. You focus on gathering all of the information, data, and opinions that will assist you in making the best decision possible and not trying to make the decision or make your decision be the quote unquote right decision. Getting it right means you accept that you don't know it all. Being right is all about being the smartest person in the room and having all the answers. Getting it right places value and premium on making the right decisions. Taking it back to my prediction, I felt so comfortable because I wasn't solely focused on what I saw in the charts or in the market. I was focused on what the research, the data, and other information I gleaned from other experts as to what they were also seeing. Because I was focused on getting it right, I was willing to challenge my own ideas and assumptions to make sure my interpretation was correct. This all goes back to that concept I shared recently around separating signal from noise. I know someone out there is saying, okay, Dr. Stacker, you're right, so what? Well, information doesn't matter much if you don't know what to do with it. My understanding of the market conditions allowed me to sit on the sidelines patiently waiting for the ideal buying opportunity. Instead of continuing dollar costs averaging in at 1920 or 1950, I was able to reallocate the money I typically put into physical metals and move that over to my oil, gas, and uranium stocks, which has worked out very well thus far. This is why the standard YouTube advice of ABC, always be accumulating or buying, drives me nuts. Without a doubt, there are better times than others to be buying. Because I was focused on getting it right, instead of continuing to buy at the same rate, I was able to sit back, be patient, and now re-enter the market $80 cheaper than it was 40 days ago. I'm not suggesting that we should try to time the markets. I'm talking about learning how to listen to the markets and interpret the data in hopes of optimizing your stacking efforts. This is how we stack smarter. In addition to that, my patience was rewarded as over the last 2 weeks, we have seen incredible sales where I was able to pick up right around 20 ounces of silver at spot and another 80 ounces or so at 99 cents over spot. You could definitely say my patience was rewarded. Enough of that. Let's turn our focus on how we can start to train ourselves to be more focused on getting it right as opposed to being right. Here are the 4 most important behaviors you need to embrace. First, start with and train yourself to ask questions such as, what is my investment thesis? How do I know if my thesis is correct? How will I know if my thesis is wrong? What information am I using to base my opinion off of? What are the conditions I should monitor? Who can I listen to, learn from, read, etc. to help me understand things better? What is working? What isn't working? What does success look like? How will I know when to exit? Second, embrace the yes and argument. This technique is not only effective as an investor, it's incredibly effective when dealing with people. The yes but response, by its very nature, is negative and creates a situation where there is a right answer or where one answer is better than the other. The yes but response shuts your mind off to other possibilities, while the yes and response forces you to shift and explore additional possibilities or alternatives. It is quite possible that there can be more than one solution or approach to a particular situation. Let me give you a few examples of how I've used yes and on this channel. Yes, I can be long-term bullish and short-term bearish. Yes, there can be a deficit in silver supplies, and that could still mean prices remain where they are. Yes, central bank buying gold could be a positive indicator, and it could also not be enough to push the markets higher. Yes, I believe prices could go to 1850, and I can continue to buy as a hedge in case I am wrong. As I said, this not only works as an investor, it works very well in relationships. Just try this next time. Yes, dear, I can see why you feel that way, and that wasn't my intention. See, that statement sounds very different than, yes, but I didn't mean it that way. Yes and affirms the original idea and still leaves room for other possibilities. Third, and this is very important, be willing to be wrong. When you focus on being right, you will hold on to a bad investment because selling means you have to acknowledge that you were wrong. I can't tell you how many times I've heard people say, well, I'm just going to wait until I get even on this investment and then I'll sell it. This perspective completely ignores the reality that sticking with a bad investment means you could be also missing out on better opportunities. A few months back, I sold some stocks that were terribly underperforming. And while I believe and still believe in those companies, I felt that taking those funds and putting them into Petrobras and Permian Resources would be a better move. Well, my willingness to be wrong on those original stock picks allowed me to free up more cash to buy more share of those two companies, which are now up 10% and 49%. As an investor, you have to be willing to be wrong and simply walk away from a bad or underperforming investment in hopes of finding a better investment. For example, while we can't believe how much silver has underperformed, and even with all of its potential upside, there are other investments that could be equally profitable. Going back to point number 2, yes and. The yes and for silver is silver could be an investment of a lifetime, and the same can be said about platinum. Fourth and finally, diversification, and not diversification in the traditional sense of spreading your investments across asset classes. I'm talking about diversifying amongst metals, like having physical gold, silver, and platinum, or diversification in mining stocks, meaning a variety of companies along the mining life cycle, from explorers to producers, as well as ETFs and royalties. As Warren Buffett says, diversification is a protection against ignorance. It makes very little sense for those who know what they are doing. This idea of diversification goes hand in hand with point number 3. Be willing to be wrong, because not every investment is going to pan out. As I shared earlier, when we talk about confusing good fortune with good strategy, you can have the perfect strategy and investment still may not work out. Just listen to what Rick Rule says about the approach most people take.
Most investors follow the dictum, got a hunch, bet a bunch. Some investors, as a consequence of the fact that they understand that they don't know enough themselves, don't invest at all. In other words, they miss the alpha and they miss the beta. But for the vast majority of investors, capturing the beta is all they need to do. For those people who are deeply involved and deeply interested, for those people who are willing to spend an hour a month on every position in their portfolio, those people could and should take more risk to generate alpha. But only those people.
One more quote from Warren Buffett. He said, diversification may preserve your wealth, but concentration builds wealth. This fourth and final point really pulls everything together in a way that it provides you with a framework to approach the goal of getting things right and not being right. Regardless of how smart, effective, and successful you are as an investor, you will get things wrong. You will misinterpret data, miss a key indicator, or simply just make a mistake. And let me give you this analogy. Think back to school and taking exams. While it would be nice to get 100% of the questions correct, that isn't the reality for most of us. However, as I've learned, if you can make sure you get the correct answers to the big questions, the ones that are worth more points, you can afford to get some of the lower point value questions wrong and still do very well. In order to be a successful investor, your focus has to shift to getting things right as opposed to trying to be right at any cost, because that cost is often your money and your investment. In the comments section, who are some of the people you watch, read, or listen to that help you get things right? Where do you think gold prices will go over the next month or so? Or simply put an A plus in the comment section so that everyone will know that you always stack smarter and never stop learning.